Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. I'm Robert Kuhn. Thank you for listening to Destination Retirement. This great Saturday, I am the host of this radio show. If this is your first time, welcome. If you're a repeat listener, thank you for coming back. If you're listening to this episode via the podcast, welcome. We certainly like to see the podcast downloads continue to go up and to the right, so we're very pleased with that. I want to thank everybody again for joining us this week. Our job as a fiduciary, as financial planners, as independent registered advisory firm is to identify your greatest risks to ultimately your retirement success and do everything that we can to really hedge against those risks. That's our goal. That's something that we're very passionate about. And certainly if you listen to the show, you know that's what we talk an awful lot about. We think that investors should certainly have a sleeve approach to managing money. We want to make sure that we have a protection sleeve, whether that's income or whether that's growth related or protection on principal related. We want to make sure we have a growth sleeve. That growth sleeve needs to be mathematical. It needs to be forward looking. It needs to be active. Active management is key. We want to have an opportunistic sleeve. That sleeve has done very well this year. If we're in a sideways market, clearly, I think that opportunistic sleeve will generate returns that you may not get in a buy and hold strategy. And then lastly, we want to have a alternative sleeve, a sleeve that has, or the returns rather, are independent of what the market is doing. And so if you have over $1 million of investable assets in that alternative sleeve, and we certainly need to have a conversation, 10% distributions and significant tax benefits to the tune of $60,000 to $70,000 tax benefit per $100,000 invested. So certainly reduce your taxable income if you sold a building, sold a company, or you're a high wage earner. Let's certainly have a conversation, especially if you're looking to convert to a Roth from your traditional IRA. That's certainly a topic that we're going to spend a little bit of time going through today. So if you want to have that conversation with myself this week, please call Paige. You can reach her at 630-492-1912, 630-492-1912, and she'll set that time up. If you did call in last week and it rang and then was disconnected, we were in the midst, and we kind of still are, of switching phone providers, and it's been, like a lot of things, somewhat of a headache. So if for whatever reason we think we have it fixed, but if that happened to you last week and you were wondering, I understand. But to certainly shoot us an email as well anytime if for whatever reason the phones seem not to work, but we think we have it fixed. But Paige, Paige at kuhncp.com. That's Paige at kuhncp.com. You can also schedule a meeting with myself that way as well. So, again, we talk about risk. We talk about risk management. I think, unfortunately in this industry, investors own two things. They own stocks and the equities, and they own bonds. And then they wonder why, their portfolio continues to just kind of do what it's doing, which is riding the Wall Street roller coaster. And we're in a very not necessarily a thinly traded market, but we've been in a very tight trading range, and it's very frustrating for a lot of people who don't have active management. And I think active management is certainly going to be at a premium going forward because it seems like we're in this 3,900 to 4,200 on the S&P 500. And, we've been stuck in that range. And if you have a buy and hold strategy, you see your account go up, you see your account go down, and your net, you're not getting, much, you're not actually making a whole lot of, moves to the upside in sustainable growth. And as you know, one of the benefits to having a sleeve approach to asset management is each of our 4 sleeves is designed to do something different. And there's a great benefit to that. I mean, certainly the protection benefit, whether it's income or whether it's principal protection, current rates on principal protection strategies currently are still 15% of the S&P 500, up to 15%, meaning you get 0 to 15 currently. No principal risk, and your gains are locked in each year. And for those that are looking for income, we can still get, you can kind of, if you have a few years to let it cook, it's not inconceivable that you could get distribution yields guaranteed for the rest of your life in the kind of that 8 to 12 to 13% range. So, that's out there, and, we want to make sure that, you're aware of it. And then the growth in the opportunistic bucket, and then certainly the alternative bucket, what's unique about that is in a sideways market, we have 2 buckets that, as of today, are certainly doing really, really well. All 4 buckets are doing well because the market's up. But in a sideways market, your opportunistic bucket and your alternative bucket that are going to pay distributions no matter what. Well, I shouldn't say no matter what, but they're not dependent upon, the market going up. That is ultimately, how you're going to outperform the market, in our opinion. Now, here's the challenge to that. When you have 4 different sleeves, it takes a little bit of understanding. It takes a little bit of understanding of the differences, the nuances of each sleeve, the return drivers of each sleeve. And to me, that's perfectly fine, because, in this day and age, what everybody wants to do as an advisor is get a client, show them what you did the last 10 years and how great you were. You may have or may not have invested that way, but you're showing the potential client that you did. And then, away you go. Well, if it takes you a 30-minute meeting to understand exactly what your portfolio is there to do, I promise you're just going to ride that Wall Street roller coaster up and down. And that could be a challenge, because as we often talked about, if you bought Microsoft in 2000, it took you 16 years to get back to even. 16 years to get back to even. So are we in that type of a market? I don't know, but it certainly seems we have substantial headwinds that we're facing, and it could be challenging. And so the 4 sleeve approach is just, in our opinion, is going to give you a better chance to succeed, really, no matter what the markets do. Because if you think about it, if the markets go down a lot, and we have that, the 4 sleeve approach, well, the protection sleeve's not getting hit. The alternative sleeve, assuming there's not some geopolitical issue, isn't going to, see, those distributions stop. The opportunistic sleeve, hopefully it'll perform well, because that is shorter term money, shorter term strategies that can take advantage of volatility. So really the only sleeve that, it has maximum exposure is your growth sleeve. And that, to me, right there, is just giving you a better opportunity to potentially, have, good returns, which is ultimately our job. So 630-492-1912, 630-492-1912. Let's have a conversation this week. A lot of questions with investors about converting to a Roth IRA. Really simple. Obviously, it makes a lot of sense to do. There's a tremendous amount of benefits to doing it. If you have a IRA, it's ultimately it's tax deferred, growing tax deferred, and then you're going to pay income taxes on the way out. And when you take the withdrawals, and those are going to be taxed as ordinary income. And I think you need to ask yourself, where do you think interest rates, interest rates, where do you think they're going? But more importantly, where do you think tax rates are going? And I think if you look at the national debt and you look at, just everything that's going on, I don't think tax rates are going down. I guess it's certainly a possibility, but not a probability. I think rates are going to continue to go up, and they're going to continue to go up for everybody, no matter what a politician says. The math just doesn't work if you're only taxing a small segment of the population. And given the debt that we currently are incurring, I think you're going to see rates drastically go up. So it does make a lot of sense to potentially convert to a Roth, but here's where I want you to stop and listen. If you're working with a big brokerage firm or a big bank, you're at a significant disadvantage when you do conversions, and I'm going to explain why. When you take a $100,000 IRA, for example, it could be $1 million, it could be $5 million, whatever the number is. But for simple math, $100,000, and you convert this year or in any year, well, you're going to have an additional $100,000 if you were to convert $100,000 of taxable income. So obviously that's going to raise your taxes due, and obviously the government wants their money. So, the benefit to that is you're going to pay taxes, hopefully, today, and then all of the future growth, you're not going to pay taxes on when you take the money out. So in theory, it makes a ton of sense. Now, here's the challenge. When you convert, you may bump up to another tax bracket. You may not have the money to pay that additional tax. So you have to look at, just do some basic financial planning. We have a conversion calculator, certainly we can talk about and help you with. But what if you had an investment available to you that in the alternative sleeve that could reduce that tax due completely or mitigate it, substantially? And that is where, when you look at an independent financial advisor, independent registered investment advisory firm, the access to solutions is far greater than the big banks and the big brokerage firms. It just is. I mean, I know it, and any advisor listening knows it. Doesn't mean the investments are good or bad. It's just that there's more access to. And what I see, that when you look at the availability of investments, it really truly comes down to tax planning and tax advantage strategies. The big firms and the big brokerage firms and the big banks, they're at a significant disadvantage to that. And there's really no proactive tax planning other than matching gains with losses, which, is not, it's better than nothing, but it's not, I wouldn't consider that, significant. Everybody's been doing that forever. So if you're going to convert your IRA to a Roth and you had access to invest in an investment that could mitigate 100% of that additional tax or offset 100% of that additional tax, well, that's a conversation that we really need to have. And there's strategies out there that, not only can you get, substantial tax benefits to the tune of, like I said earlier, $100,000, you're able to reduce your taxable income by $60,000 to $70,000. And you can do the math if you put in 2 or 3 or 4 or 5 or, $1 million or $5 million, whatever it is. But if you're looking to convert, we need to have a conversation about that. 630-492-1912, 630-492-1912. And we can certainly have that conversation because, yes, let's convert. But let's take it the next step and let's invest some money in a strategy that can mitigate or remove that additional, tax due or, additional income that you're going to have. Now, I want to caveat that by saying certainly we don't provide tax advice and we're not CPAs. But it's a very basic tax strategy, a very basic depreciation. If you own a business, you know what depreciation is. But as long as the investment is set up correctly, those tax benefits are available to you. But we always recommend you talk with a CPA, your CPA, or if you don't have one, we certainly have a handful that we've worked with for years and can certainly provide you some advice. So with that, a couple of things that, I also want to talk about this week. When we look at objections to people making changes of their financial advisor, there's generally 4 or 5 that, continuously come up. And I want to spend some time going over those this week, because I'm sure if you listen to the show and you haven't reached out, well, there's a reason why. And, maybe it's one of these 5 reasons, maybe it's not, but I'm going to certainly spend some time this week going over the core objections that I hear from investors, because, working with an advisor isn't a lifelong contract. And unfortunately, I think if I'm, 9 out of 10 advisors are adding almost no value to a relationship, meaning you're paying an annual fee to just have your money go as the markets go, up and down. And there's really no advantage to working with an advisor. And when you're paying a 1% to 2% annual fee and you're not getting any, outperformance, whether it's tax related or performance related, that fee adds up. In over 15 to 20 years, it really adds up. And so we want to make sure that, there are some advantages to working with advisors, and we're going to certainly share those starting in the next segment. So with that being said, give us a call if you want to have a conversation, 630-492-1912. We're doing a lot of 401k management. If your 401k is currently at Fidelity, if it's at Charles Schwab, if it's at Empower, we can help you manage your 401k in an absolutely unique strategy that has mathematical algorithms, that has significant outperformance since 2002. So we can certainly help you. So if you have, I want to make sure that we talk more about that certainly today. So 630-492-1912, more after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. I am your host, Robert Kuhn. I'm also the president and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. Our job, as any advisor's job should be, is to keep a fluid financial plan that can really identify your greatest risks to your retirement and to your retirement success, and make sure that we're doing everything we can to hedge against those risks. And there are strategies that can be put in place that you can protect, can hedge. And when I look at financial planning and I look at investment management in 24 years now, or maybe 25 years, generally what I see is that most advisors have no protection, or not advisors, clients rather, have no protection, whether it's growth or principal or income, and they have no hedges in place inside of their portfolio. I mean, if you're driving a car today listening to the radio show, you have to have car insurance. Why? Because you're preventing against the unknown. If you own a home, you have homeowners insurance, health insurance, life insurance, renter's insurance, business insurance, et cetera, et cetera, et cetera. But yet when it comes to your portfolio, you have no hedges in place. Why? When we know once out of every 4 years, ultimately the market's going to go down, and it may go down substantially. So if we can protect against that while not foregoing ultimately upside, well, that's probably a strategy that you want to hear about. So with that being said, give Paige a call this week. We can have a conversation, 630-492-1912, 630-492-1912. You can also go to the website, kuhncp.com. Listen to this show. We do podcast every episode, so you can go there, kuhncp.com, and listen to past shows. I don't know what we're at with this time slot. We've probably we have 60 shows maybe from this time slot when we were at our earlier time slot. Unfortunately, those shows didn't move over, but a couple years worth of shows will give you plenty of kind of idea of our thoughts and how we manage money. So a few things I want to, if you haven't been with us since the start of the show, protection strategies, whether it's income or growth, the current principal protection strategy, we're still seeing a rate of 15% on the S&P. So that's current as of today, certainly could change. But as of today, that means you get from 0 to 15% of whatever the S&P price movement does. So nothing on the downside, and anytime you get a gain, that gain's locked in, so it's locked in for the life of the investment. So really great bond repair strategy. Fixed income last year was down generally anywhere from 13 to 30%, and that shell shocked a lot of investors. Not only did they lose 15 to 20 to 25% of their equities, they lost 13 to 30% of their fixed income, and they're looking for answers. Well, we have to look at it. So let's use the power of the market, but remove the potential for, obviously meaningful losses in the protection strategy. Opportunistic strategy. If you have $2.2 million of investable assets, I encourage you to give us a call. You can invest in our fund, and my fund is very opportunistic. We can go long, we can go short. It's anywhere mathematical type strategy. Phenomenal flexibility. It's not my minimum requirement. It's the SEC's minimum requirement. So we work with investors who have $100,000 and investors who have 50 to 60 to $70 million net worths. And so that's but for that particular fund, you have to have $2.2 million of investable assets or $1 million with our firm. But I'll tell you, what I see lacking is in traditional financial advisors offering is really three things. Protection, very limited on the protection strategy. They're still using fixed income as a protection method. How'd that work for you last year? Opportunistic, there's just most people just don't have any opportunistic money. And what is opportunistic money? Well, it's really just trying to ride the momentum in the market. And again, it may be 10% of your portfolio, 15% of your portfolio, but that's phenomenal. There's phenomenal opportunity when you see volatility, especially in a very range-bound market like we've been in. That money can potentially really significantly grow. So I don't see that offered much by traditional financial advisors. And then lastly, in the alternative sleeve, like we talked about in the first segment, I very rarely see, anything other than real estate offered in the alternative space, especially if you're at a big brokerage firm or a big bank. You're just missing out completely because, we have access to strategies that can greatly reduce your taxable income, substantially reduce your taxable income, and is currently paying 10% in a industry that is just going to be here forever, in our opinion, but, very predictable income stream and cash flow. And again, if you need to convert that IRA to a Roth, and we can mitigate, that tax due, whether your IRA is 100,000 or 10 million, let's have a conversation. 630-492-1912, 630-492-1912. So, based on research, there are really 5 objections that we as financial planners incur when working with or talking with new investors. And I understand change is hard. I get it. Making a change is really hard. You don't know me other than the radio. And, we certainly, are doing a lot of Zoom meetings. We're meeting in person. We love it. We're meeting at Starbucks, whatever. I mean, it's just so easy today to get in front of people. And we like to say, don't let your location determine the quality of your advice from the financial advisor. And yes, it's nice to be able to walk down and knock on a door, but at the end of the day, you have to work with somebody that has cutting edge strategies. We think we fill that gap because, we have 4 unique sleeves that all have different return drivers, different risk return methodologies. And we work with clients all over the United States. And yes, we're headquartered, here in the Chicago area. We have, a big presence in Texas, a big presence in Florida, a big presence in California, certainly a pretty big presence in the Midwest. But don't let your location determine the advice that you get. It's just something that you have to really, really watch. But typically what we hear is, number one is, I already have an advisor. I mean, of course. I mean, most investors have an advisor. A couple things that we, hear is if you don't have an advisor, generally you're doing it on your own, which is perfectly fine. I mean, I think if you're doing it on your own, you just, the only way you're going to make money, generally speaking, is if the markets go up. I want to know about your protection strategies, your opportunistic strategies. What are your alternative strategies? Generally, if you're managing the money on your own, you're at Fidelity or a Vanguard at Schwab, and that's who we custody. Our money with is our clients' money with is Charles Schwab. That's neither here nor there. They don't make any recommendations on whether we're good or bad. We certainly meet basic criteria to have all of our clients at Charles Schwab. But anybody who works with us does establish an account at Schwab with the help of my assistants, and then we manage the money. And at any point, if you don't want to work with us, well, you call Charles Schwab, and we're no longer removed, or we're no longer on the account, and then your money is still at Charles Schwab. So, but we often hear, I have an advisor. Most people do, and that's okay, because just having an advisor really doesn't mean a whole lot to us. I mean, again, 9 out of 10 advisors, you're paying a fee to just track the market up and down and feel good, or they make you feel good when you see significant losses in your portfolio. I mean, if you want to track the market up and down and you believe that's the most efficient way to manage money, who am I to tell you what to do with your investments and your money? It's your money. People who hire us, we always respect the fact that it's their money. They're just hiring us for, our expertise and our advice and our strategies, and providing access to things that you just simply don't have access to without working with people like myself. But that's okay if you have an advisor. So if you are thinking about reaching out, there's something that is not working with your current relationship. And I get it. It's hard to change, but is it hard? We have a lot of people that come over, and hire us, and leave an advisor relationship of 5 years, 10 years, 15 years, 20 plus years. And that's okay, because you don't owe us anything. You owe yourself and your family everything. So, making a change is okay if it's going to better your situation. 630-492-1912, 630-492-1912 if you want to have a conversation with us. But if you're currently working with an advisor, generally there's something missing. And where we win most business is because of our sleeve approach, because we're not just a one-trick pony where we own equities and we own bonds. And yes, you may have tons of mutual funds, tons of stocks, tons of ETFs, and a bunch of bonds. But again, you own two things. And in this day and age, that's just not going to cut it. Where we win most of our business, and why we win most of our business, is because of the protection sleeve, because of the growth sleeve, because of the opportunistic sleeve, and then certainly because of the alternative sleeve. And that is where we win our new clients, is because they recognize the fact that we're giving you a much better chance to succeed. And when you lose less, or when you can protect against loss, or you have investments that are still delivering significant double-digit returns, because even when the market's down, well, inevitably that is an advantage. That is attractive to many investors, that especially in this market. I mean, I don't think we're going to see a raging bull market anymore. I think, if you believe in statistics, it's going to be a tough 2 to 5 years. And for those people that don't think the markets can trade sideways for an extended period of time, again, Microsoft in 2000, if you bought it, it took you 16 years to get back to even. We had the lost decade in the early 2000s where, for a 10-year period, we didn't see any gains. So those things can happen. And when, you subscribe to the philosophy that we do, which is really simple, if you lose less, ultimately you make more. Well, you do that by having, different return drivers. I mean, I guess that's true asset allocation, and that's true diversification, but that's such an overused word and phrase, because you could look at a statement and see, 100 stocks and think, wow, I'm diversified. Well, no, you're not. I mean, you may be diversified in the equity space, but you still own equities. And you look at the correlations of what happens in equity, in the down market. Well, everything pretty much moves in tandem. So where's your protection strategy? Where's your future income strategy? Where's your opportunistic strategy where you can actually take advantage of the volatility and actually make money when the market's going down or going up? And then where's your alternative strategy that can help you convert, your IRA to a Roth and mitigate or eliminate that additional tax due because you're investing in a strategy that has alternatives? So, we get it. Everybody has an advisor for the most part. And, our job is to respect that relationship, of course. We're never one to put down other people. I mean, goodness. I mean, that's just not us. I mean, our job is to just simply look at your portfolio, look at your goals, your objectives, and make sure that we're providing a much more efficient way to get you there with much less stress and potentially make much more money. I mean, at the end of the day, that's our job. So next couple is I don't have any money. I'm not interested. I want to think about it. The price is too high. So we'll get to that after the break. You want to give us a call again, reach out to Paige, 630-492-1912, 630-492-1912.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. Thank you for joining us this Saturday morning. Hopefully you're having a great weekend. If this is your first time joining us, welcome. If you're a repeat listener or you're catching the show via podcast, thank you for joining us and welcome back. If you do want to have a conversation with us, here's what that conversation is going to look like. Our job, I think, as a fiduciary, as registered investment advisors, and being certainly independent as we are, is to make sure that we are identifying your greatest risks to success in retirement, whatever that means to you, whether you have $100,000 or $50 million of investable assets. There are risks, and we want to make sure that we identify those and that we create a strategy that can hedge against those risks to the greatest extent possible. So if you don't have that, or if you have questions, if you have that, certainly let's have a conversation. 630-492-1912, 630-492-1912. Call Paige. She'll set some time up for us to have a conversation this week. Couple things, protection, obviously, 15% currently. We've mentioned that each segment. So you get the 0 to 15 on the S&P 500 currently. Certainly can change, but that's what it is currently. Gains are locked in each year. Your worst year is zero. So great bond repair strategy. And I want to, again, certainly with tax time, we just passed. If you want to talk about a Roth conversion, let's have that conversation. Take that IRA, convert it to a Roth, and then ultimately the future, growth and withdrawals are tax-free. Not a new strategy, but what is new is this. If we could reduce and you could allocate some money to a strategy that could reduce some or all of that additional tax that's going to be due on the conversion, that's probably something you want to hear about. I promise you, if you're working with a big brokerage firm or a big bank, you can certainly do the conversion. You can do the conversion anywhere, but that's simple. That's a commodity to convert to a IRA to a Roth. Where we're bringing value is, what if we could mitigate that tax due? So what if you had a $100,000 IRA or a $5 million IRA and you wanted to convert that, pay the tax today, and then have those future assets, future growth and distributions be tax free, and we can convert or reduce all of, or a large portion of, or even some of that tax due with an investment that's going to currently pay you 10% distributions, that's not tied to the market, it's in the alternative space. That's probably something you want to have a conversation with us about. So a lot of those conversations are taking place currently. 630-492-1912 if you want to talk about it and see if it makes sense for you. 630-492-1912 and set some time up with Paige, and we'll certainly have that conversation with you. Okay, so I already had an advisor. Well, that's one of the things that when people are looking at making changes, when we're talking with potential new clients, it's probably the number one thing that comes up, which is fine. Good. I'm glad you have an advisor, because once you go through our 4-sleeve approach and we talk about how we're actually making money or mitigating your losses in down markets, it becomes very easy for you to recognize the value that we bring that you just certainly don't have at your current advisor. So we like that. Very easy to do. Second is, I don't have any money. Well, we hear that a lot, and we hear that from people that think, well, I need to have a certain amount of money to work with you. And there certainly are firms that if you don't have $1 million, they won't help you. If you don't have 5 million, they won't help you. And that's their prerogative as an advisor, is to set whatever minimum investment that they want to set. We have gone the opposite way, meaning we just don't care how much money you have. And we think you need to have a certain amount of money for us to help you. But, generally at a minimum, it's kind of $100,000 for us to really kind of start to bring in kind of the planning process. Now, our average client is, probably, somewhere in the low seven figures. But that doesn't mean that we don't have many clients that have $100,000 to $1 million of investable assets. We have decided, and I made a conscious decision, that we're not going to be that advisory firm where we turn people away because you don't meet some sort of a stated minimum. You still need help. And, are the strategies different? Well, sure. I mean, if you have under $1 million, some of our offerings are going to be a little different from our clients who have 3 to 5 to 7 million, but that's okay. I mean, we want to replicate, the strategies that we bring for our higher net worth clients to those that have $100,000 to $1 million as well. But we're not going to make you feel bad. I mean, you still need help. My goodness. I mean, I've always said, whatever you have, you're rich. And that to me is something that we adhere to. So same intellectual capital, same financial planning. The strategies may be, different, but that doesn't mean that, we're not here to help you. So don't think that, because everybody needs a plan. So, if advisors think they're cool and they're great advisors because they say, if you don't have $1 million or $2 million or $5 million, we're not going to help you. Well, so be it. We'll take and work with those individuals all day long, because, we're here to help everybody, not just a certain segment of the market that benefits us more so than, working with other people. So, and also, what we do hear a lot of is you may not have a lot of money outside of your 401k. A lot of individuals have the bulk of their assets are inside of their 401k. And that's a challenge, because all of that onus is on you. And if that's your biggest asset and it's 100,000 or 500,000 or $1 million or $2 million or whatever that number is, and you really don't have a whole lot of different options or strategies rather inside of a 401k, they're generally very generic. They're generally very limited. So I want you to please hear me. If you have a 401k at Fidelity, at Charles Schwab, at Empower, generally we can help you manage your 401k with a strategy that is, mathematical based model that has significant outperformance of the S&P 500 since 2002, has the ability based on math to go to 100% cash if needed to protect in volatile periods. So if you have a 401k at Fidelity, Charles Schwab, Empower, and I'm sure there's other ones out there, but those are the three that I know. More times than not, we can work with you and help you. The money doesn't leave your 401k. It still stays in your 401k. The company still matches everything. It's just there's an opportunity for you to have professional money management. Again, reach out to us. I think the minimum for that is $50,000. So, 50,000 or 5 million, again, it doesn't matter to us. It all adds up if we're looking at it selfishly as far as what benefits us, but that's not how we look at things. So, I know, US Foods and AT&T, all of the airlines. So if you're, an airline employee, you have access to it. There's so many companies in the Chicago area that use Fidelity, Schwab, or Empower. So if you're one of those and you want, cutting edge professional management inside of your 401k, certainly let's have a conversation and we can see if we can help you, share with you the returns, the process, the methodology. And if it works for you, it's just a few signatures to add us or the management to your 401k. And again, it doesn't leave the 401k. It's still there. So I don't know why you wouldn't do it. 630-492-1912, 630-492-1912 if you want to talk about that. So I'm not interested. That's another one we hear. I mean, that's an easy answer. I mean, we don't make unsolicited outbound calls to people. Our marketing, if you look at what we do, it's all almost the radio, and that's our outreach. We do have a couple, we do some webinars, and we do some dinners, some educational workshops, etc. So if you certainly want to get on that list, and if it's in an area that's convenient for you, and you want to, join us, we certainly, would love to have you. Give Paige a call, 630-492-1912, 630-492-1912. But yeah, that's an easy throwaway. I'm not interested. I mean, I get it. No doubt. I do it all the time. I mean, I don't, again, we're not making cold solicitations. Generally, always it's people have reached out to us, but not everybody that reaches out follows through, and that's okay too. But so when we hear I'm not interested, that's fine. You reached out to us, and there was a reason why you reached out to us, and maybe you forgot that reason, or it wasn't, it just was easy. We caught you at a bad time, or you, so I'm not interested as, whatever. I mean, for a lot of people, it's just an easy throwaway. But I guess the question I have is, do you have four sleeves that can create an overall portfolio that hopefully can lose less when the markets, go down, which allows you to make more when the markets go up? Do you have strategies that, can greatly reduce your taxable income and still pay 10% distributions? And, if you're looking to do a Roth conversion, why are we not talking about that? The conversion part is a commodity. Anybody can do that. That's simple to do. Let's follow through with what if we can mitigate all or a lot of that tax due on that conversion. That is what makes us unique. That is where we're adding a significant advantage versus our competition. So we really want to have that conversation with you if you want to, obviously, convert. So you convert, if we can mitigate that tax due, and then that money is going to grow tax free, and those distributions are going to be tax free in the future. Well, obviously, it's something that we want to have a conversation about if we can. And again, it's just tax planning. It's not matching gains versus losses. I mean, that's ridiculous. I mean, that is tax planning, and I shouldn't say it's ridiculous, but it's so basic that I wouldn't even consider that tax planning in 2023. So, and again, if you're at a big firm or you're at a big bank, I promise you do not have access to these strategies. I've been in the business 25 years. I know this for a fact. So, strategies that if you invest $100,000 in, we can greatly reduce your taxable income by, $50,000, $60,000, $70,000. So with that being said, we're going to talk about the price is too high. So we're going to talk about cost and fees next. So give Paige a call if you want to have a conversation with us, 630-492-1912, 630-492-1912.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want defined outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. My name is Robert Kuhn. I'm the host and founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm, and we're a fiduciary. I don't want to repeat exactly what we do, but if you're just joining us, I encourage you to go to kuhncp.com, kuhncp.com, and catch the whole show and all of our past shows. So we do podcast every episode, but I think in its simplest form, our job is to identify your greatest risks in retirement and make sure that we are trying to create a portfolio that can hedge against those risks. You hedge in every area of life. Why are you not hedging against risk inside of your portfolio? Well, you are. You're hedging with time. That's most 9 out of 10 advisors. That's their only hedge inside of a portfolio. What I mean by that is you have no proactive strategies that can do well in down markets, or can take advantage of down markets, or can protect against loss in down markets, or as in our alternative strategy, still pay 10% distributions annually, irregardless of what's going on in the market, whether it's up or down. So your hedge is time, meaning if we look at your portfolio in 5, 7, 10, 15, 20 years, it's going to be higher. Well, that's, generally speaking, very true. A couple of things to think about. You bought Microsoft in 2000. That took you 16 years to get back to even. You don't have to go too far back. In the early 2000s, we had a 10-year period of no growth. So certainly time is an okay hedge, but probably shouldn't be a real hedge if you have, if you're in your 50s or 60s or certainly retired. We need to have additional hedges in place. So we can help you with that. Again, Roth conversions. Let's talk about the Roth conversion. The conversion's a commodity. Anybody can do it. But what if you had a strategy that you can invest some additional assets in and reduce all or some or a large portion of that additional tax due? So then your conversion in the Roth is going to grow tax-free, and those distributions are going to be tax-free. So that's the big deal. $100,000 or $5 million IRA. Let's talk about conversions. Let's talk about investing in a strategy that can reduce some or all of that additional tax that's going to be due with that conversion. So give Paige a call. We'll have that conversation. 630-492-1912, 630-492-1912. 401ks, we talked a lot about that this week. If you have a 401k currently with your company and that company, your company uses Fidelity or Charles Schwab or Empower, there's a very high likelihood that we can give you cutting edge professional management inside of your 401k. You don't need to, nothing changes. 401k still stays as is. You still contribute. We can just bring you a strategy or access to a strategy that has the ability based on math, very complex, to go to cash when cash is needed to prevent and protect your portfolio in volatile periods. And it has their growth models have significant outperformance of the S&P 500. I mean, almost to the tune of double, depending upon date, clearly, of the S&P 500. So a lot of people were really making a big push with that because, the 401ks are so limited as far as how you can manage risk. And most people don't know that, if you're with Fidelity, Schwab, or Empower, there's a high likelihood that we can help you with that 401k. So I think the minimum on that is $50,000 for the 401k program. So give Paige a call, 630-492-1912, and we'll set that call up and we'll see if we can help inside of the 401k as well. So, okay, so I have an advisor. We talked a lot about that this week and why most of our current clients come from people who have had an advisor. Again, our competitive advantage is 4 sleeves: protected income or growth. Growth, opportunistic, that gives you an opportunity to make money as long as there's volatility, which if we're in a sideways market, that bucket has been doing absolutely well. We don't want to talk about performance, but the strategy for that bucket excels when there's volatility. So, we'll leave it at that. And then the alternative bucket, obviously, substantial tax savings. I mean, meaningful tax savings. And 10% distributions are being paid currently. So again, all of these investments are, there's risks without a doubt, and there's pros and cons. So, just because we talk about a lot of the positive attributes on the radio, that doesn't mean that there's not risks and concerns. I think our job is to point out, those concerns, those risks, and then craft a portfolio that gives you a better chance to make money if the markets are sideways to down. And so if you have an advisor and you don't have, 4 sleeves that have, different return drivers that have different, will perform differently in all, different markets. That's why, advisors or clients rather are coming over to us when they're having another advisor or they're managing it on their own at, a Schwab or a Fidelity or whatnot, one of those types of places. So, the last one is, generally what we hear is cost. Fees are really interesting in this industry. Nobody works for free. I mean, come on. everybody wants to think they're getting something for free, but would you work for free? I mean, no. I mean, so what's the best answer is just transparency, radical transparency. To us, that is so important. There's a couple ways that we're paid in this industry. Fees, so an annual fee. We can do a flat fee, like a financial planning fee. If you don't want us to manage the money, you just want a full-blown financial plan and meet with us once a year. Okay, there's certainly a value there, and we'll come up with something that works for you and us. But predominantly, we're a fee-based business, or a fee. Yeah, really, the industry is, mostly fee-based, meaning we're going to charge you a percentage of your assets and to manage that money. Another way that we get paid is commissions. Generally, the only way you get a commission is if we do a protection strategy or an income strategy, and we're going to tell you what that commission is. You don't pay it. It comes from the issuing company. But again, I think it's still important for you to know how we're compensated. But, I see all too often, I guess the question that I would ask is, if you just had a portfolio that tracked the market up and down and your advisor was bringing nothing that was unique in any way, what would what's too expensive? Well, I think paying somebody anything is too expensive if that's the scenario, because you can go to Fidelity, you can go to Schwab, you can go to Vanguard. And if you believe that the most efficient way to manage your money in this market at these levels, with this risk, with this inflation, with, where we've come the last, 10 years is to just buy and hold, then you just don't need to work with an advisor. You don't save the fee. I don't think that's the most efficient way to manage money, but it's certainly, again, it's your money. So who am I to tell you what to do with your money? But so I think paying an advisor anything is too much if that's what you're doing. And another thing that I see an awful lot of is to pay an advisor to just go and pick mutual funds or pick ETFs. Why? I mean, you have the mutual fund fee, which is 1% to 2%. And the ETF fee is non-existent, obviously, but those are things that you can do on your own. And if you don't want to do them on your own, you can call an 800 number and they can walk you through how to do it. Again, there's not a lot of value being added there. So we see a lot of that. I think when you look at, let's look at our alternative strategy, right? We currently charge 1.75% a year on that strategy. People say, oh my gosh, it's so expensive. Okay, fine. It's certainly more expensive than, just an S&P 500 fund, but let's look at what it does for you. Well, we can greatly reduce your taxable income. So what's that cost? I mean, what's that worth to you rather? You invest $100,000 or you invest $1 million, you say you invest $100,000. Well, we could reduce your taxable income, by $60,000, $70,000. That's what that strategy will do. It'll allow you to convert IRA to Roth. If you don't do that, it'll just drastically reduce your taxable income, and it pays 10% distributions. So is that worth 1.75? Well, if it's not, then don't do it. But we think that's a very fair price for all that you're getting. And so when you look at fees, you have to look at what is the benefit that you're getting. On our individual equities, for example, on our growth strategy, it's 1.5. Well, that's the only fee. There is no hidden mutual fund fees. There is no hidden mutual fund fees, then an advisory fee on top of that. So let's look at it. So it's 1.5%, but it's managed for the maximum after-tax benefit for you if it's in a taxable account. Generally, you lose 1% to 2% based upon simply taxes if you're in a mutual fund. So you don't want to pay 1.5% to have maximum transparency, maximum tax efficiency, and strategies that are rated from the top 1% currently to the top 5% of all managers in the small cap, mid cap, dividend, all cap, and focused growth strategies. Well, then don't pay it. So we have to look at the after tax or the after tax after fee return. That's what matters. The protection bucket, again, those generally pay commission, and the company that issues it pays the commission. So you're not directly paying it. And then in the opportunistic strategy, it's 2%. Actually, the opportunistic strategy outside of the fund is 2%. Inside of the fund, it's 1.5%. But what's that worth to you? I mean, let's look at, again, the strategy, the returns, the flexibility, the ability to potentially make money when the markets go down, the ability to hedge in ways that, you're certainly probably not hedging currently. Well, those each 4 strategies have, independent fees. So when we have a client that puts money in all 4 of those strategies, generally the fee, given the fact that the protection strategy, I mean, think about that. You don't have to pay a fee, no annual fee, and you don't pay the commission, and you get 0 to 15% currently of what the S&P 500 does. So the S&P does 10, you get 10. Does 15, you get 15. Does 20, you get 15. Think about that as a hedge to the down market. Think about that as a bond replacement. And then when you get that gain's locked in for the life of the investment, so you'll never give it back. You never have to recoup losses, and you're not paying a commission or a fee. Well, I mean, that could have some value to people. But when you allocate to that, and then you use the other 3 strategies, generally your fee in working with us is somewhere in that 0.5% to 1% range on the total relationship, depending upon, allocation accordingly, or of course. So what's that worth it to you? I mean, you're paying, and if you do it on your own, the fee is if the market's down substantially and you're down like the market, well, there's your fee. Well, you just lost, market's down 20, you lost 20. Well, there's your fee. Well, what if you worked with us and our strategies were only down 7 net of fees, for example, hypothetically? Past performance certainly isn't indicative of future results and all of the necessary caveats that you need to know. But that's your true fee, is if you lose substantial amounts of money, well, there's your fee. So most people don't find or have a problem with a total relationship of costing 0.5% to 1% a year if there's value being brought to the table. So our 4-sleeve approach, we think, certainly brings that value. If you don't have it, let's have a conversation this week. I want to wish everybody a fantastic week. Give Paige a call, 630-492-1912, 630-492-1912. Let's have a conversation this week. Until next week, make it a great week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.